A new accounting standard, IFRS 17, is expected to have a significant impact on the insurance market. I'm Yvette Essen for A-Invest TV, and I'm joined by Carlos Wong-Fupuy, Senior Director, to talk about what the impact is likely to be when the International Financial Reporting Standard is imposed. So Carlos, tell me, what is the difference first of all between the current standard, IFRS 4, and the new one that's likely to come about?
Well, probably first of all, after a long period of preparation and discussion, finally we've had the standard published in May last year, with an effective date 1st of January 2021, which means companies in effect have a relatively short period for preparation. They have to prepare comparative figures as well for the previous year, 2020. In terms of the objectives of IFRS 17, I would say in one word, it's consistency and comparability across the world. We have to understand the current standard, IFRS 4, was always conceived as an interim standard, and it adopts the domestic valuation approaches that we have in each jurisdiction, which means that for global insurance groups, we may have an amalgamation, a consolidation of numbers which actually don't have much to do with each other. In certain jurisdictions, you can have very prescribed regimes, very formulaic approaches with assumptions which are set by the regulator, by the local regime, and others are closer to what IFRS 17 is actually prescribing now, which is more principle-based, more market-based, without any margins for prudence. So the idea is to have a basic model which applies to all jurisdictions. There are still going to be some issues of comparability, especially at the beginning, because it's a principle-based regime. So there are some areas of interpretation, like discount rates, like how companies decide to segment their business, for example. But with time, we expect those approaches to converge and help comparability, especially when we see the current situation.
Now, there's a bit of a perception that it's mainly the life companies that will be impacted by the changing standard. Is that really the case, or is there likely to be an impact on the non-life market as well?
I think that there are reasons to believe that this is mainly a life insurance issue, but that doesn't mean that non-life insurance companies can ignore IFRS 17. By no means that's true. First of all, IFRS 17 doesn't make an explicit distinction between life and non-life business. There is a general model which is probably most appropriate for life business. It's based on the discount fulfillment of cash flows, so that's the basis of the calculation. There are two new elements in the balance sheet. One is the non-financial risks adjustment, and the other one is the so-called CSM, the contractual service margin, which represents the not yet recognized profit which is expected to arise from a particular contract and which will be recognized as that contract is fulfilled. Now, for companies which write short-term business, say business with less than a year cover, with no complexities, no options or guarantees, and where companies can show that the calculation is relatively similar to the general model, they can apply an exemption, the so-called premium allocation approach. This is very similar to what non-life insurance companies already do these days, applying an unexpired risk premium approach. But that is only going to apply to future unexpired service. So all previous service still is under the scope of the general model. The other thing to bear in mind is that we have a number of non-life companies writing multi-year business. So we have large corporate risks, we have liability risks. So in all those areas, the general model is most likely to apply, and by no means companies can think that they are outside the scope of IFRS 17.
Do you expect there to be any impact on our ratings of companies in a post-IFRS 17 world? And our analysts are going to have to change what they're doing with regards to rating companies.
In terms of immediate impacts, I wouldn't expect anything significant. The AM Best approach is always to try to see a company from an economic point of view. So to the extent that the current accounting standards are reflecting that economic reality, I wouldn't expect significant differences. When that's not the case, analysts tend to make some adjustments to get closer to that economic view. Obviously, IFRS 17 is going to provide additional information, additional detail that we can't ignore. And if I look at the new criteria framework that we have at AM Best, the new BCRM, and at the different building blocks, I can explain a bit how this may impact the way analysts view their companies. For example, the first block, balance sheet strength. There are two new elements in the balance sheet, this non-financial risks adjustment and the contractual service margin. And there are some arguments to consider that probably analysts should give some at least partial equity credit for something that, according to the standard, is considered a liability. There are some analysts who expect some volatility on the balance sheet as well. We think that that will depend on how closely matched the assets are to the liabilities, and so that I wouldn't make a generic statement about that. It will depend on the particular situation of some companies. Regarding operating performance and business profile, I think that because IFRS 17 requests that companies differentiate, make a clear segmentation of which groups of contracts are actually loss-making, analysts will have more granularity when they analyze the sources of gains and losses when looking at the operating performance. The same is going to happen with the business profile. So a company can have a very strong business position in particular segments of business, but analysts will be able to see if actually those lines of business are making profits or are underperforming in respect to the rest of the portfolio. Finally, when it comes to ERM, again, I think that more granular information is something that not only the analysts have available, but companies themselves as well. So I would expect some refinement on the way of how they incorporate that information in the risk management, and if there are any implications on how they manage their capital and their dividend policy as well, that may have some impact on the way analysts assess risk management.
AM Best has published a report looking at the impact of the new accounting standard. That report can be found on ambest.com. For AM Best TV, I'm Yvette Essen.